Okay, so in this video I'm going to look at variable overheads. So from the budget and the flexed budget and the actual results, we can see the original plan was to produce 5,000 units at £8 variable overhead per unit, and the original budget showed £40,000. The actual production was 5,300 units in this production run, and so the flexed budget, what was expected, was £42,400, but the actual variable overheads came in at 41,500, giving a £900 favourable variance. So I've taken some basic information from the previous screen. So here we can see the standard cost card. Variable overhead is charged at 4 hours per unit at £2 per hour, giving £8 per unit. And here variable overheads are based on labour hours, and you can see here that the actual results were 5,300 units. Now the labour hours were 20,750 paid labour hours, but only 20,100 worked labour hours. Now it is assumed that variable overheads are only incurred when labour hours are being incurred, and that there are no variable overheads incurred with idle time. And so when we come to calculate the variances, we use the 20,100 worked labour hours as a basis for the overhead variance. And very similar to direct labour variances, the total variance of £900 favourable is analysed into its price and its quantity elements. The price part is called a variable overhead expenditure variance, and the quantity part is called the variable overhead efficiency variance. Just like labour hours, similar to labour hours, the unit of purchase for variable overheads are hours. And here we put in the variable overhead rate of £2 per hour to give what should have been expected, a variable overhead rate of £40,200 for the production, or rather for the number of hours used. And in this row, these are the actual figures. It shows that 20,100 hours of variable overhead actually cost £41,500, and therefore the variable overhead expenditure variance is 1,300 adverse. So you can see really that 20,100 hours cost £41,500 when it should have cost £40,200 for the variable overheads. So per hour the variable overhead was more expensive than it should have been according to the flexed budget. And the second subvariance is called the variable overhead efficiency variance, which is very similar to the labour variance. Again, this time it's worked out on units of sale. There were 5,300 units produced, and the standard hours per unit were 4, and therefore the 5,300 units according to the standard cost card should have taken in hours 21,200. And actually what did it take? It took 20,100 hours, it took less, and therefore there's 1,100 hours of favourable variance there. And then if you turn that into a pound value, it comes to a value of £2,200. And the favourable variance of £2,200 shows the saving in the variable overhead cost at standard rates coming from fewer labour hours than the standard expected for the 5,300 units of output or units of sale. And it's always good to check. The total variance we know was £900 favourable. Now that was made up of a £1,300 adverse price or expenditure variance, and it was also made up of a £2,200 favourable efficiency variance, giving £900 favourable. So we know that the variance calculations match the total variance. And so to continue building the operating statement, I'm simply going to copy these variances over. So the variable overhead expenditure variance was what, £1,300 adverse, so I'm going to put £1,300 into the adverse column, and the efficiency variance was 2,200 favourable, so I'm going to put 2,200 into the favourable column, and so soon we should be able to total these columns up. And so the final variance to look at is the fixed overhead variance. And here we can see that the original budget was 60,000 for the fixed overheads, the flexed budget was 63,600, and the actual results came in at 64,800, giving an adverse variance to the flexed budget of £1,200. So I've summarised some of the information that's needed to calculate the fixed overhead variances. Just here from the standard cost card, we can see that the fixed overheads on the cost card were 4 hours at £3 per hour, giving £12 per unit. The actual number of units made, as before, was 5,300, 20,750 hours paid, 20,100 worked. The original budgeted production in units was 5,000. So I've taken this from the original budget table and the flexed budget table, and that's just a copy of what we just looked at, the 1200 adverse. And so the fixed overhead variance can be, the total variance of 1200 adverse can be analysed into the fixed overhead expenditure variance and the fixed overhead volume variance. So the two original subvariances are the fixed overhead expenditure variance, which is calculated, note, from the non-flexed budget. So it's not the flexed budget, it's the non-flexed budget, the original non-flexed budget, where the fixed overheads were estimated to be 60,000, and at the end of the production run the fixed overheads actually incurred were 64,800, giving a variance in pounds of 4,800 adverse. And the second subvariance or analysis variance is the fixed overhead volume variance. This one is almost similar to the sales volume variance. It says original budgeted production units of sale were 5,000. The actual production during the period was 5,300, and it gave a variance in units of 300 units, and it was favourable. So why is a cost variance favourable? Well, the answer is very similar to the sales variance, the sales volume variance. More sales equals greater profit, and here it's more production equals favourable variance. And so because we had more production in units, 300 units, then what we then need to do is have a look at turning the 300 units into a pound value. Here we have 300 units for sale, extra, and the standard fixed overheads per unit are £12, and that gives a total favourable volume variance for fixed overheads of £3,600. It's always good to make a check, so if I take the fixed overhead price or expenditure variance, it was £4,800 adverse, and the fixed overhead volume variance was £3,600 favourable, and that gives a total variance of the subvariances to be 1,200 adverse, which matches the total variance. Now the fixed overhead volume variance of 3,600 favourable can be further analysed into further subvariances, subvariance A, fixed overhead efficiency variance, and the subvariance B, fixed overhead capacity variance. So the fixed overhead efficiency variance uses very similar, almost exactly the same as the labour variance, except that it changes the rate per hour. And so here we have the units of sale, actual units of sale, actual units of production, times the standard hours of fixed overhead absorption per unit, gives the total hours of 21,200. So that was the reflexed, what should have been taken in hours. What it actually took in hours was 20,100 hours, which were the worked hours, which is exactly the same as the labour efficiency variance. And here, quite simply, because what we expected it to take and what it actually took, and because what it took was less than expected, it's 1,100 hours favourable. Now the variance of 1,100 hours favourable at the absorption rate of £3 per hour gives a £3,300 favourable fixed overhead efficiency variance. And because the absorption basis is labour hours, then the fixed overhead efficiency variance that we see here will be due to the same causes as the labour efficiency variance. Here meaning that the workforce worked faster to produce the number of units. And the second variance to analyse the fixed overhead volume variance is the fixed overhead capacity variance. In some ways it's tempting to overthink this, but essentially this variance measures whether more or fewer hours were actually worked, than were budgeted from the original budget. And here we can see the original budget production was 5,000 units at 4 hours per unit, giving a total budgeted number of hours of 20,000, and they are labour hours. And the hours actually worked were 20,100. And in a similar vein to the sales volume variance, where more sales gave a favourable variance, here more hours also give a favourable variance. And so we can see here that during that production run, more labour became available somehow, and 100 hours labour extra was found, and that variance of 100 hours at £3 per hour gave a favourable variance of £300. And so it's good to do a check. The total fixed overhead volume variance was £3,600 favourable. The total fixed overhead efficiency variance was £3,300 favourable, and the total fixed overhead capacity variance was £300 favourable. And there we have, it matches, it balances. So moving on to the operating statement, I'm simply going to transfer these figures from the fixed overhead variances into the operating statement. So the fixed overhead price or expenditure variance was 4,800 adverse, and I'm just going to put that into the correct column, 4,800 adverse. And the fixed overhead volume variance was 3,600 favourable, so I'm just going to put the 3,600 favourable into the favourable column. And so I totaled the column, the favourable column, and I made a total of the adverse column. I deducted the adverse column from the favourable column, and it gave a total of 958 adverse. Now taking the new profit from above and deducting or adding minus £958 gives the final actual profit of 55,292, which, if we look at the original table that we made, the original budget, the flexed budget and the actual results, we can see that the actual profit was 55,292. And looking at this table, we can see that at a glance we can see that materials price was adverse and materials usage was adverse, and so the managers might want to look at why that is the case. Again, labour rate was adverse, meaning that there was more paid to labour than was budgeted, but the labour efficiency was favourable, very favourable in fact, at 8,800. So for whatever reason the workforce worked faster. Of course there was some idle time, and so the management might want to look into the reasons for that. The variable overheads have a relationship to labour, so having a favourable variable overhead efficiency variance is to be expected. So all in all, the operating statement that we see here gives an explanation using the variances, or looking at the variances that we've calculated and analysed. It'll give a picture of why what actually happened was different to what was budgeted or expected to happen. And it also explains why the actual profit was different to the budgeted profit. And that brings to an end the 3 videos that I've done on variances, basic variances that is. Thanks for watching.